In this video, I'm going to provide an update to my business cycle risk score analysis for September 2019. As a preview, I have seen improvement month over month, but still the indicators are telling me that we are still in a little bit of a cautious time here with respect to the business cycle. So I definitely want to share with you exactly what I'm seeing and how I'm thinking about it. If you are new to my channel, my name is Jared Ayers. I am a CFA charter holder and have created this channel to share with anyone who's interested the strategies, thought processes, and techniques I use to invest my own money. This is exactly one of the examples of the things that I like to share. Certainly understanding where we are in the business cycle is something I believe is a cornerstone to investing effectively in the market, so that's why I've created this channel. So before we jump into the analysis, I do want to mention that in previous videos I have laid out in a considerable amount of detail the types of things I do when looking at this data, and I will link back to the videos and playlists where I go through all of that so that you can see the detail if you wish. This video is going to be at a fairly high level, just skimming the tops of the waves, so to speak, with respect to what I'm seeing and how I'm thinking about these indicators and what they're telling me I should be doing with respect to my portfolio allocation. So without further ado, let's get into the analysis. So as in previous updates, what you see is a capture of my screen, and this is my business cycle risk score update for September 2019. So although I told you I would link to all of the videos and playlists where I go into detail in terms of how I actually calculate these scores, I will just remind you at a very high level how I do this for those who are new to my channel and how I look at these indicators. So as usual, we have the 13 indicators that I use on the left here. I've categorized them in terms of their predictive power, whether they're leading or lagging. I assign a predictive power weight based on that determination, and then of course there's a time weight based on how current the most recent data is for that indicator, and then from that I can come up with a total weight, and that then tells me whatever I decide about that indicator. It kind of determines what the weight or how much believability I should give to that indicator. From there I then look at the direction and also the rate of change of the indicator. So a cornerstone of how I look at this data isn't just whether it's increasing or decreasing, but is it accelerating or decelerating or just kind of staying flat and steady. So that then produces a score. My scoring system, maximum is +3, minimum is -3, based on how all of the weightings flow out. Basically that leaves me with a maximum of +30 and a minimum of -30. I then convert that to a 10-point scale just so I understand it kind of from a basic scale of 1 to 10, and that's where I get my actual risk score. So you can see here for September 2019 the risk score is 3.4, so quite a bit better than the most recent update, which was August, where we had a score of 1.7. That was definitely the lowest I've seen in quite some time. This looks to be like a little bit of a recovery, but still I think an indication that I certainly should remain cautious in terms of exposing myself to equities for sure, and I'll get into how that whole thing translates in a little while here. So just to remind you, this is the August risk score update now. You can see the score of 1.7. The major difference between these two scores really is a very vast improvement in terms of retail sales and the non-manufacturing PMI. They both stick out notably. I'm just going to flip back here to September. You can see non-manufacturing PMI is +3, retail sales year over year is +3, where August it was -3, and then -2. So you can see that those two have certainly turned the tide, with non-manufacturing PMI being a leading indicator. That gives it a score of 1, so definitely the largest weighting in my list. Next, of course, is retail sales, which is actually a lagging indicator, so it doesn't get quite as much power, but still, versus every other indicator, still a contributing factor here. Some of the other things that were decreasing at an accelerating rate, the yield spread between the 10 and the 2-year, the producer inflation rate, US Fed funds interest rate, and the CPI inflation rate. Those are all still decreasing, but have not as aggressively as they seem to be in August. So these are kind of decreasing at a steady rate. Still a negative in terms of the overall score and not adding much, but still an improvement period over period. The other one that's kind of flattened out is the unemployment rate, so that's actually gone down as a result. It gets a 0.25 rating, mainly because it's flat, steady, and also lagging. So not contributing as much as it was in the previous month, but with unemployment being as low as it is, that's not hard to understand, and just can't probably go much lower than it is. So that's sort of a summary of the risk score. So 3.4 in September, 1.7 in August, definitely better. So just to quickly talk about how that translates into asset class allocations. Again, these are the ranges, mins and maximums, and the corresponding asset class allocations that I personally assign based on these scores. So this is completely my own concoction. You're not probably going to find this anywhere else unless someone's copied me, because I just sort of made this up as I went, and certainly it's subject to change as I continue to invest and learn and grow as an investor myself. So right now, of course, that means that we're in this range here at a score of 3.4. All these scores are kind of related to the minimums here. So, but the range kind of indicates that, you'd be at a minimum 20% equities, 20% bonds, 50% cash, 5% gold, and 5% futures. So, still very cautious overall. So for, comparison, and where we are right now, in September, 3.42, I've taken these to 2 decimal places, really just because the equities are a little bit different, 35 and 36%. If both of these said 3.4, then you might wonder why. But basically, like I said, June, 4.9, July, 3.36, so 35% equities, bonds, cash, gold, minus futures, as they are there. August took a real deep dive. That would have told me to lighten off in equities, to as low as 9%. I didn't end up doing that. There's some equities that I held that I believed were so deep value positions, there just wasn't any point in letting them go. Plus I wanted to see what September was going to tell me in terms of what the indicators were going to do. But I certainly did come off closer to this 35% mark, bonds, cash, etc. And then September, of course, we see a bit of a rebound. So so what? September's come back a little bit. When I'm looking at these, I'm looking at trends as well. So if you look at kind of the moving average for the 3 months ending August, you kind of get an average of about 3.33. If you're looking at the 3 month period ending September, your average is about 2.83. So on average, the moving average, if we're looking at that, the trend is still down. 3.42 out of 10 is not a high score, so it's still telling me I need to be fairly cautious. sort of back into this range now, so heavy to cash, light to equities relative to what I could be. Some decent amount of bonds there. 5% gold, 5% managed futures, so making sure I have exposure into those safe haven asset classes as well. So again, it's something to consider. This is where I look to first whenever I decide on how I should be allocating my assets, and is kind of the first stop before I start to then go in and decide what I want to hold in each of these baskets. So before I'll go and start researching stocks and picking those, I want to make sure I understand kind of what the macro business cycle is kind of doing, and therefore how I should be allocating my portfolio. So I hope you found that helpful. So like I said, hopefully you got some utility out of that analysis. By all means, let me know if you look at the business cycle indicators or any other kind of indicators to kind of come up with your own macro view of the economy. I'm always interested in hearing other points of view and methods to come up with those types of analysis. Certainly for myself, like I said, this is the first thing I do. I have to come up with my own macro theory at least before I decide what to do. I know this isn't telling me everything. It's a quick way for me though to get a gauge on what is going on, with all the other noise out there. So I do genuinely hope you did get something out of that, and of course leave me anything you want in the comments. If you agree, disagree, want to see more, want to see less, I'm open to it all. So if you did like the video, please do give me a thumbs up. If you are new to my channel, by all means hit the subscribe button if you'd like to see more of the same types of content in the future. Until next time, thank you very much for watching.